Hello everyone, welcome back to the channel. It's your favourite Scotsman here again. Today we're diving into a topic that's crucial for anyone planning for retirement. RRSP versus TFSA income strategies. Have you ever wondered whether to utilise a tax-free savings account or a registered retirement savings plan to maximise your retirement savings? Well, you're in the right place, because in this video we're going to break down the strategies for both, giving you the information you need to make informed decisions for your retirement. Okay, first off, we're going to look at when not to use an RRSP before retirement. Contributing to an RRSP, it's often the automatic default option for Canadians when saving for retirement, but it can sometimes be detrimental. As a general rule of thumb, if your annual income is under $50,000 a year, just don't bother with RRSPs. If you're making under $50,000 a year, you're very, very close to being in the lowest tax bracket. Contributing to your RRSP could have a negative impact. Let's look at an example. We've got Jim here, who's making 50 grand a year and contributes $5,000 to his RRSP. Files his taxes, and based on that contribution, Jim's going to get roughly 20% or $1,000 back as a refund. $1,000 in your pocket that you didn't have before? Nobody's going to sniff at that. Fast forward a few years though, and Jim's now retired. Jim's spouse, Janet, was a government worker with a sizable pension. To reduce Janet's tax bill, Jim and Janet decide to income split her pension. The result? The income Jim reports in his tax return is $55,000 a year. Jim wanted to take the $5,000 out of his RRSP that he contributed a few years earlier. He'd be paying roughly 30% or $1,500 in tax on the withdrawal. Now here's where my expertise comes in. $1,500 is in fact more than $1,000. On the other end of the scale, even if you're a high earner, you have to be wary of having too much in your RRSP and running into OAS clawback issues. For more detail, you may want to check out another video of mine on 5 ways to avoid OAS clawback, which you can find here. If you have an income of just shy of $87,000 or more in 2023, you will start to lose a portion of your OAS benefits. Once your income exceeds a total of just over $142,000, you lose it all. It may sound dramatic, and that's because it is. Your OAS could be wiped clean. The takeaway from this is simple. Have a plan in place and know what your projected retirement income is. This will help you figure out if it even makes sense for you just to be arbitrarily throwing money into your RRSP. Just a short break here. If you're enjoying today's video and haven't already subscribed to the channel, please consider doing so. We'd really appreciate it, and you don't get to miss another video again. Okay, back to what you came for. So now that we've covered when not to use your RRSP, we're going to move on to when to use your RRSP. This is a specific strategy for those getting very close to retirement and works best for high income earners in a high tax bracket. Let's take Morris. Currently makes 250 grand a year and is comfortably in the 50% tax bracket. Morris is planning on retiring at the end of this year. Despite his high salary, Morris isn't sure if he can make an RRSP contribution as cash flow is a little tight, as he's aggressively focusing on paying down debt before he retires. We fast forward to February 2024, Morris is now retired. Doesn't have his $250,000 salary anymore. Morris borrowed $50,000 from a line of credit just before the RRSP deadline to make the contribution. Remember, any contributions you can make in January and February count towards the previous tax year, which is exactly what we want in this case, as Morris was making a lot of money in 2023. Once he files his taxes in April, he's going to get about 50% or 25 grand back as a refund. Morris could then withdraw the $50,000 from his RRSP. This would count towards his 2024 taxable income, and given that Morris is now retired without the high salary, he could expect to pay somewhere around about 20% in tax or $10,000. The net outcome is that Morris has give or take an extra 15 grand in his pocket that he wouldn't have had without some planning. Obviously, this is a pretty basic example, and Morris is relying heavily on his spouse Samantha, who is still working to pay the bills for the rest of the year. That said, this can be applied in a number of situations and is something to think about if you find yourself in a similar situation and struggling to get the cash flow to make RRSP contributions in your final years of work. Next, we're going to look at the TFSA, which is a simple yet often overlooked strategy. There's a strong case to be made that all retirees should keep some sort of balance in their TFSA. Why? It's easy access to tax-free capital. If all your money is locked up in an RRSP, what are you going to do when the car breaks down? Or when the roof needs reshingled? Or the furnace sputters out in the middle of winter? Remember, every dollar that you take out of your RRSP is taxable. So if you need to take out a large sum in an emergency situation, just like those mentioned, this could end up putting you in a suboptimal situation from a tax standpoint. How much should you have in your TFSA heading into retirement? Depends on your situation and how many things you own that could essentially break. If you rent, then you're likely going to need much less than a homeowner. My favourite retirement strategy is to contribute to the RRSP, take the refund and put it into the TFSA. This way you're slowly building up both. Next up is another strategy that synergizes with a well-stocked TFSA. The Guaranteed Income Supplement, or GIS, offers over $12,000 tax-free annually to low-income seniors over the age of 65. If your sole income source is old age security, or it potentially could be your sole income source, then you may want to listen a little closer for the next minute or so. I'm not suggesting for a second that you try and live in OAS and GIS alone. Unless you're extremely frugal, you're likely going to need some other access to funds. This is where the well-funded TFSA comes into play. You can use the TFSA to supplement your living expenses, and it's not counted as income towards the GIS calculation. You could also consider cashing in some RRSPs before hitting 65, or contributing to RRSP before 65 and using the deduction later for maximum GIS. A couple of key items for this strategy: delay RRSP to RIF until age 71 and CPP until age 70. As an added bonus, remember that deferred CPP until 70 means 42% higher payments for life, while postponing your RRSP conversion lets it continue to grow. The last strategy we're going to look at today is the one that I call the forgotten RRSP contribution. As you approach the age of 71, there are certain rules and opportunities surrounding your registered retirement savings plan that you need to be aware of. By December 31st of the year that you turn 71, your RRSP must mature. This means that you must decide whether to withdraw the funds, transfer them to a registered retirement income fund, or a RIF as it's commonly referred to, or utilise them for an annuity. Importantly, you won't be able to make further contributions to your individual RRSP after this milestone. Contribution room available in your RRSP is based on the previous year's income, which sets the stage for a unique scenario in the year that you hit 71. Now, if you're still gainfully employed in the year that you turn 71, you'll have earned income that could potentially generate additional RRSP contribution for the following year. However, the catch is you're no longer permitted to contribute to your individual RRSP after this point. This is where the forgotten RRSP strategy steps in to offer a potential tax deferral solution. The strategy is simple yet effective. Just before the year's end, estimate your earned income for the current year to gauge the RRSP room you'll be granted on January the 1st of next year. The room is calculated as 18% of your previous year's earned income, capped at a maximum threshold. Ensure you've already made the RRSP contributions to use up all the room mentioned in your notice of assessment. Here's where things get interesting. Make an additional RRSP contribution before the year concludes, equal to the projected room for the following year, Now, remember, this contribution is an over-contribution, and it does carry a penalty of 1% per month on the excess amount. Don't fret about that penalty though. It's manageable. You file a T1 OVP to report the over-contribution and remit the penalty to the Canada Revenue Agency within 90 days of the new year. For instance, if your next year's RRSP limit is projected at $20,000 based on current year's earnings, consider adding that sum to your RRSP in advance. This incurs the one-time penalty, which could be $180, provided your lifetime over-contribution limit hasn't been exhausted. Deduct the additional RRSP contribution on next year's tax return, or carry it forward to claim deductions in future tax returns. January the 1st of the following year, your previously considered over-contribution becomes legitimised as new contribution room emerges from your earnings. The penalty will only apply for a single month, and the taxes saved through deductions and the advantages of tax deferral and compounded growth typically outweigh the 1 month penalty. That said, it's highly recommended that you discuss this strategy with your accountant or financial planner. Navigating through your retirement journey requires planning, and in this video we've gone through just a handful of the many strategies that are out there. Should you be using a tax-free savings account or a registered retirement savings plan to maximise your retirement savings? Short answer is, depends. For Canadians, contributing to RRSP is almost seen as a rite of passage and just the automatic default when it comes to saving for retirement. But as we've covered today, sometimes a TFSA is a better option. Whether you choose to harness the tax advantages of an RRSP or leverage the flexibility of a TFSA, remember that maximising your retirement is ultimately about making choices that align with your individual goals. If you found this video helpful, don't hesitate to like, subscribe and share your thoughts in the comments below. Thank you for joining us, and until next time, here's to securing a prosperous retirement ahead. And don't forget, a good financial plan understands your goals, but a great one knows the motivations behind them.